Do private trusts have to file state returns? I get this question a lot from, trustees in training. And, the answer, I don't think the answer is very complicated. We're going to get into the answer. We're going to get into all of that on this episode of The Foundation. I would like to say peace. My name is Sot L, seeker of truth L, speaker of truth L. This is The Foundation. I'm more than excited that you have chosen to be here with us. We just trying to kick the knowledge, y'all. Education is important. There's more than just public education. So, do private trusts have to file state returns? We're going to get into that. But first, a word from our sponsors. Be sure to check out welcometothefoundation.com. Sign up for the email list, por favor. That's please in Spanish. We got some luxuriousness going down for y'all. We're getting everything together. Exclusive event invitations, notifications. We send out informational emails, exclusive emails with regards to just subscribers. It's a luxurious dance. All you have to do is put your email in the box right there. That's at welcometothefoundation.com. There's a lot of resources on here. You can get a link to where you're at right now, YouTube page. We have education. If you're interested to start learning about private trusts, it's known by many names: Peer Trust, Massachusetts Trust, Common Law Trust, so on and so forth. Common law trust, I say, is a misnomer. There's no such thing as a common law trust, y'all. No such thing. It is a contract trust, technically, that owes its existence to the common law right to contract. We have the common law right to contract unlimited. It's a very, very powerful right. And if you understand it, it can put you in a very, very powerful position. Speaking of, we have the most comprehensive trustee training available. You learn how to create trusts. You learn how to administer trusts. It's an educational program. It's private education. You ready to go private? Link in the description if you are interested. It is, I would say, it's that dance. It's that dance. And then you can start your business first. You can do that after you start your trust. You set up your private estate. Generally, a private estate is going to have a business trust, an asset protection trust, and a family trust. But, starting a business is very, very important. The worst structure to exchange your labor into the public with is the individual. So we suggest you start your business. Link in the description of this video to sign up if you're interested. Last but not least, we have the Foundation magazine. It's luxurious print or digital subscription. Wow, here we go. You can get it in your email or in your mailbox. It's a luxurious thing. We're celebrating over a year. I got to update this to cover. This is from last year in April. I'm just going to keep it real. I'll update it. That's my fault, y'all. But it's still the most luxurious magazine you'll ever get your hands on, especially in the digital age. You can get a physical magazine. If you're into that, link in the description. Let's jump into it. Jump into the show. So what do I find this? This is wealthmanagement.com. I like to use publicly available sources. I don't come out here with the stuff you don't know where it came from. It came from some weird guru that disappeared. We don't know if he, figured it out and got to, hollered at by them peoples, or if he went on a vacation sponsored by, the federal government. We don't know. But we can't really verify those sources. Most people are interested in public verification, is what we're taught. It is what it is. So, wealthmanagement.com, how are trusts taxed? We're going to jump down here. Do all trusts pay income tax? It depends. A trust is a separate legal taxable entity. You guys get this? Remember when I said that the individual is the worst entity to utilize with regards to the exchange of your labor in the commercial marketplace. And regardless if you comprehend that's what you're doing and what you've been doing, it doesn't take away from the fact. Whether the trust pays its own taxes depends on whether the trust is a simple trust, complex, or grantor trust. This is how the IRS classifies trusts. So they're giving you information right here. Simple trusts and complex trusts pay their own income taxes. Grantor trusts do not pay their own taxes. The grantor of the trust pays the taxes on a grantor's trust income. That's a very, very significant statement because it's true, 100%. And it lets you know that these living trusts, any trust where you are the grantor and the trustee, it's a grantor trust. It doesn't matter what jurisdiction you think you have in the document. It doesn't matter what the powers of the trustees are or what the trust indenture itself says. If the grantor and the trustee are the same, it is an alter ego. It is a disregarded entity for tax purposes. A simple trust is a trust that, A, requires all trust income to be distributed at least annually, and B, has no charitable beneficiaries, and C, makes no distributions of trust principal. If a trust does not meet the above definition of simple trust, it is either a complex trust or a grantor trust. Notice how they don't go into complex trust. They jump into grantor, right? Though there are other grantor retained powers that make a trust a grantor trust. The above are the most common. So what is that? Grantor retains power to substitute trust assets with assets of equal value. Grantor retains power to borrow trust assets without adequate security. Grantor or grantor's spouse may receive distributions from the trust. Trust income may be used to pay premiums on life insurance policies on life of grantor or grantor's spouse, aka irrevocable life insurance trusts. Also, if the grantor retains any power with regards to the trust administration, if the grantor retains any power to revoke the initial assets of the trust that the grantor, placed in the trust, and if the grantor retains any power to substitute trustees to name or unname, I know that's not grammatically correct, but whatever, you know what I'm saying, beneficiaries, that would be considered what is known as a grantor trust. It's a disregarded entity. The income from that trust must be claimed on the individual tax return. That's very specific. Next, we got Witham. I don't know what these guys are. Some advisory company. They do taxes and digital solutions and cybersecurity and accounting and advisory. Is your trust subject to state income taxes? The fact that this is even a question that is being addressed should tell you something. Number one, there are 4 main questions to determine whether the trust is subject to state income taxes as a resident trust. First one, was the grantor domiciled within the state at the time of the creation of the trust? Number 2, where does the trust document or agreement indicate the trust is to be governed? I'm going to go back to that one. What state does the trustee reside? And what state does the beneficiary reside or beneficiaries? A trust may be considered a non-resident trust. Non-resident. So if it's not a resident of the state, then it subsequently has no duty or requirement to file a state return. What makes a trust a non-resident trust? Well, I don't know. Generally, if a trust is not considered a resident trust, you see what they did there? You see what attorneys, man, these guys. Whew. Then it is a non-resident trust, which is subject to income tax to the extent the trust generates state-sourced income, you paying attention? From an activity earning income within the state, such as a rental or business type activity. So, is it receiving income from within the state? Is the income effectively connected with the trade or business within the state it is operating or it is being administered? That's a good question. A lot of people don't consider that. But effectively connecting income is a big deal. It's a really big deal. It's a big deal. But here's what I want to say, right? I said I want to go back to this, right? Where does the trust document or agreement indicate the trust is to be governed? I'm going to tell you 100% of the time, 100% of the time. I'm not even going to say 99.99, infinity. I'm going to say 100% of the time. You go to an attorney unless that attorney is a family friend or you grew up with that guy or girl or whatever, and they're doing you a personal favor because they understand contract law as well as statutory law, 100% of the time they're going to draft an indenture or trust instrument that is governed by state law. I've seen this thousands of times. I got my trust, man. You want to let me see the indenture? Let me see it. And they show it to me, and I just pointed to them like, look, it says this trust or contract or agreement, however it's drafted, is to be governed by the laws of the state of, and then it says a state on there. The fact, listen, powers of deduction. The fact that this is even a question to be determined should tell you something. It doesn't say what state. It doesn't say what state. Because trusts, they're international. You can read the Hague Convention on the Recognition of Trusts. They are international. Where does the trust document or agreement indicate the trust is to be governed? That's very important. Goes through some stuff. Y'all can look this up. I don't know. With them. Do a search. I'm going to move on, though, because I don't want to take too much of your time. The tax advisor. You got it? Whether you have an existing trust, SALT. SALT is state and local taxes. State and local taxes, SALT. Whether you have an existing trust or are creating a new trust, location matters. The total tax owed by a trust can be significantly affected by the location of grantors, beneficiaries, trustees, and even the trust assets. This is especially true for the tax years of 2020 and 2021, where people were working from home, so on and so forth. Trustees and planners can no longer ignore the ever-expanding reach of states in their pursuit of state and local tax revenue. A trust can be taxed as a resident trust in multiple states or in no states. You see that? Or in no states. It's a possibility. You think that's true? A single characteristic may classify a trust as a resident trust in some states, while in other states, a combination of factors is required. Currently, 8 states, Alaska, Florida, Nevada, New Hampshire, South Dakota, Texas, Washington, and Wyoming, do not tax the income of non-grantor trusts. These are tax advisors. They know that the IRS recognizes 3 types of trusts: grantor, simple, and complex. Why would they say non-grantor trust? Why wouldn't they just use the actual terminology? Because they have a fee to charge. The remaining states tax a trust based on a number of factors. 1, residency of the testator or the trustor. That'd be the grantor. 2, administration of the trust. Where is it being administered? 3, residency of the trustee. And 4, residency of the beneficiaries. This residency, jurisdiction. Jurisdiction is important. Let's move forward. I got another one. Navigating trust taxation. State income tax. Like individuals, trusts are subject to income tax by the federal government and a majority of states. If a trust is characterized as a grantor trust, then its income is reported by the grantor thereof, who is usually the trust creator, because, usually the grantor and the trustee is the same person, and taxed as if earned by the grantor individually. There's no tax. No tax benefits for a living trust. There's benefits with regards, and check me on this, there's benefits with regards to avoiding probate. There's no litigation benefits. There's an alter ego. If the trustee, who is also the grantor of a living trust, is sued, those assets are not protected in that trust. It's an alter ego. It's for real. If the trust is characterized as a non-grantor or trust, then it is a taxpayer separate from the grantor and could owe tax to the federal government or one or more states. Whether a state is entitled to impose income tax on a trust depends on the law of the state and generally looks at the following factors. Jurisdiction where the trust was created. Where was the trust created? Very important. Jurisdiction and administration of the trust. Where is the trust being administered? Residency of the trustees. Residency. Domicile, or residency? They say residency of the trust beneficiaries. Very important. Let's do this and let's get up out of here. Because I love y'all and I know y'all got busy things to do in 2025. By the way, happy fiscal new year. I trust that your holidays were luxurious. Trusts, common law, and IRC, 501c3 and 4947. This is actually from the IRS. You can check this out. I'm going down to page 10 if I remember correctly. Yep. Does a trust have to be registered with the state? No state filing. You see this right here? No state. Unlike corporations, LLCs, or limited partnerships, trusts generally do not file their governing instrument with the state to become legal. However, a will that includes a testamentary trust is filed with the court as part of the will probate process. Look, the IRS just gave y'all some game. Trusts generally do not file their governing instrument with the state to become legal. However, a will and blah, blah, blah. A few states have adopted Article 7 of the Uniform Probate Code, which requires the trustees of all trusts to register in the court of the principal place of administration of the trust. The Uniform Probate Code imposes penalties on the trustees for failure to register, but does not invalidate the trust. The trust instrument usually indicates the state law under which the trust is organized. If it doesn't, did you guys know that a trust instrument does not have to have a state law under which it is organized or governed? The determination specialist, so this is the IRS, should ascertain the state law. What if they can't ascertain the state law? What other law would the trust fall under? And get a representation from the trust that it is properly organized under the state law, particularly if there is doubt as to the validity of the trust. So listen, you see they have to make sure that it's properly organized under state law. So if you're organizing your trust under state law, then the answer would be yes. The trust must file a state return. But if it's a private trust and it's not organized under state law, and the trusts that are not filed with the state to become legal, I would go so far as to say there no state filing. But this is the IRS. No state filing. I think this is very important. I think this should be studied. I think a comprehensive study of this material is warranted and necessary. If you're looking to administer trust, go private, get free, zero out the accounts, all this stuff, SPC, you need to trust and you need to know how to administer trust. You need to. You want to protect your assets from probate, litigation, creditors, death tax, inheritance tax, generation skipping tax, gift tax, income tax. I'm going to tell you right now, it's got to be a complex trust. You got to understand what that is. The public ain't really going to teach you what that is. It needs to have not been filed with the state, and it needs to not be organized under state law. This is IRS. And of course, I'm using powers of deduction or, reasoning, deductive reasoning. But what is inclusive doesn't necessarily mean it's exclusive, if you understand what I'm saying. And I'm just kicking it so y'all can understand where I'm coming from, because, this stuff, it's out there. It's out there. I was speaking to a gentleman earlier who's very angry. He said, we got tricked and they didn't tell us. And I'm like, they don't need to tell us. It was up to our families to teach us this stuff. They gave us an individual because we were ignorant. Our families were ignorant. So they issued an individual certificate and they issued a social security number. So the ignorant peasants could do business and exchange their labor. I'm serious. The truth hurts sometimes. We've been walking around using notes and individuals. But there's another way. And if you're going to use their stuff, they're going to tax you. And when you pass away, they're going to tax you because, honestly, this thing is about families. It's 100% about families. The Rockefellers is a family. The Rothschilds is a family. The Carnegies is a family. The Waltons, they're a family. This is families, and it's about family wealth. And, we got to comprehend that or not. But if we don't get it from the family, if our families don't put us on, we can't expect the public to put us on, but the information is out there. And with that being said, if you're looking to learn how to administer trusts as well as create them, create the contracts themselves, you don't need to buy one. You just write one down. You open up your laptop or jump on your PC or Mac and you just type a trust because you know how, because you were in trustee training. You know how to go open the trust checking account. You know how to open the trust brokerage account. You don't have to call anybody. You know how to do it. You can teach your heirs because the trust never dies. The bank account never closes, y'all. When you pass, it's the same person. I've showed you multiple spots where it says if it's not a grantor trust, the trust is a legal and separate entity. And if it doesn't die, it never goes through probate. The accounts are never taxed through list. Do you understand what I'm saying? Same thing with vehicles, same thing with property, same thing with life insurance, same thing with, brokerage accounts. There's so many things to get it back into your family. Because as far as I'm concerned, if it's titled in an individual name, it's not yours. That's titled in the public because that individual was created by the public. Actually, the state has a state seal on it, not your family seal. And that's why I ask, are you ready to go private? I think it should be mandatory. This education should be mandatory like public school is. And they come in and throw you in truancy and try to threaten your parents and arrest your parents because you ain't going to school. It's that serious. This information should be that serious. And I apologize for getting really serious. Usually I'm really, really chill and stuff. But, I'm passionate about this. I really am because I understand what it does. And to me, this isn't a black and white thing. This has nothing to do with nationality or color. Because I'll say this, and when I speak it, you'll know it's the truth if you've never heard it or thought it. No matter what color you are, nationality, what your heritage is, I'm sure you rocking a social security number too. I'm sure you're filling out an individual form 1040 and hoping and praying for a nice return this year while every check you're getting money taken out of your check, man, before you even get it. To me, that's slavery. That's energetic slavery, economic slavery, however you want to look at it. And there's ways to do it from a more powerful, and I would say more honorable, remaining in honor position. Use your own private family structures to do business. Been doing it for over 15 years. Y'all can do it too. Link in the description. Because, this stuff is happening every day. People are waking up every day. People are choosing to go back to sleep every day. But with that being said, y'all enjoy yourself. I hope you learned something. Take care of yourself. Make sure you say 10 things that you're thankful for before you go to sleep tonight and every night. It's very important. And I'll catch y'all next time on The Foundation. Peace, y'all.